All right. So that policy loan now makes it to where your available cash value is $1 million again. But your accumulated value is still 1,100,000. Why is why do you still have an accumulated value of 1.1 million and now you have an available value of 1 million and they were both the same? It's because you borrowed against your policy. What it's saying is when you took that money out of your policy, you didn't actually take your money. You used your money as a collateral to borrow other people's money, right? So now you have what I like to call twin babies, right? Twin babies. And who doesn't like twin babies? You have your cash money in your hand to spend out in the real world, and you have the digital cash that's technically still in there earning interest. Because guess what? When the next year comes around and there's another 10% growth, it's not going to be getting 10% off the available cash value. It's going to be getting 10% off of the 1.1 million, right? So for example, let's say if you had $100,000 and you borrowed out 90,000. So that means your accumulated value is still your accumulated amount is still 100,000, but your available amount is now only 10,000 because you borrowed out 90,000. But that next year, that 10% that your policy is going to earn is going to be earned off the higher number, the accumulated amount, because that money is still in there earning interest technically. So in that scenario, instead of just earning $1,000 because that's 10% of 10,000, you're going to earn 10,000 because that's 10% of 100,000. The same in this scenario. When the market goes up 10%, that's going to be 10% of $1.1 million, and that's going to come to a total of $1,210,000 accumulated value, right? You're getting charged at 4%, 4.5% policy loan interest, and that's going to mean your policy loan balance is going to be a total of $104,500. Your available cash value now is going to be $105,500. And guess what you're going to do? You're going to borrow $100,000 again. And you're going to keep doing that until the year you die, to the day you die. You're going to be able to borrow this out as long as it's there, as long as you have the available cash value and you set it up the right way. This money will continue to pay you in tax-free money that's not considered income per IRS purposes until the day you die. But it has to be structured correctly. Because here's the thing. If you're only looking at today and you're only worried about what's happening within the next 5 years, then IUL probably isn't the best thing for you. Because if you actually pay attention to it, when you look at the different options that you have for money vehicles, in the first 5 years, a life policy is probably the most expensive vehicle that you can get. But all I got to do is have you think about it like this. What if there was a 5-story building, right? What if there was a 5-story building, right? And you bought this building. You would prefer to rent this building out 100% starting from day one, right? You want the first floor rented out, the second floor, the third floor, the fourth floor, the fifth floor rented out from day one. That would give you your most money, right? This is what you would prefer to have, every floor rented out from day one. But what if I said you got to follow some rules? If you follow some rules, I can have it to where all the money that you're making from that house is 100% tax free. But you got to follow some rules. You got to follow 72E, 7702, and 101A. 72E says as long as something is considered a life insurance policy, it grows tax deferred. 7702 says as long as something is considered tax life insurance and you access the money correctly, you can access the money tax free. And 101A says as long as something is considered a life insurance policy whenever you die, whatever's left in there is going to blossom to a larger number and pass to your beneficiaries tax-free. But you just got to follow these rules. You got to follow Tamra, Tefra, and Defra. Tamra, Tefra, and Defra. Tefra, Defra, and Tamra. And I know what you're thinking. And no, this is not the names of the supporting cast from the beloved 90s sitcom Moesha. No, this wasn't her best friend's names. No. What it is back in 1980, E.F. Hutton, which is a brokerage company, brought this to the masses, right? And what happened was people started doing a run on the banks. What they were doing is they were taking all of their money, hundreds of thousands, millions of dollars out of the traditional financial institutions, and they were using it to pay single premium life insurance policies. And remember, because it's a life insurance policy, it grows tax-free. They can access it tax-free, and whenever they die, it blossoms to a larger number and passes to their heirs tax-free. And the IRS said, you can't do that. You can't just be making single payments to where your death benefit is exactly the same as your accumulated cash value. You can't be doing that. And they say, well, yes, you can. So guess what? The IRS sued E.F. Hutton, and the IRS lost. And you know what happens whenever the government loses, right? They change the rules. So what they came up with in the 1980s, over a number of years, is Tamra, Tefra, and Defra, which is certain rules that you have to follow to make sure that you have the Tefra Defra corridor and you're following the premium payment rules when it comes to supplying these things. So how do you follow those rules when it comes to a life insurance policy, and how does it make a life insurance policy the most expensive vehicle in the first 5 years? Well, just like this building, you cannot pay off a properly structured index universal life policy in the first 5 years. It has to be paid over 5 years. It used to be 7 years, but and it's still 7 years for whole life policies. But for properly structured index universal life policies, you can have these things paid off in approximately 5 years. Sometimes a little more, sometimes a little less. But what this is saying is, what if it's one of those situations where it's that 5-year mark? It's saying, hey, even though I know you want to have this building filled up every floor starting from day one, but how about this? If you follow these rules, first year, I only want you to rent out the first floor. The second year, then you can rent out the second floor. The third year, then you can rent out the third floor, and the fourth year, the fourth floor, and the fifth year, the fifth floor. If you just every year only add one floor of rented out rooms, then when you hit 5, we're going to set it up to where all the money that you're earning from this building is 100% tax-free without nobody moving out for the rest of your life. If all you had to do was not rent out the second floor the first year, the third floor, and just only rent out the floors each year by year, and after year 5, that it'll be 100% tax-free and nobody would be moving out, would you not take that deal? I think you would. And once again, what that means is the cost of insurance is the most expensive in the first 5 years of a properly structured life policy. So that first year, it might look like you're losing money. Also, because you can't max fund it, you can't put in as much money as you want, as fast as you want, it's not going to be growing that fast. However, as long as you follow Tamra, Tefra, and Defra, and you fill this policy up over the next 5 years, then it becomes a cash cow, as my mentor Doug Andrew likes to say, a cash cow.